Hello, and thank you for joining us this morning. My name is Simon Chong, and I work as the Chief Business Officer at MYTHEO. As you have seen, Russia has launched an invasion against Ukraine on the 24th of February, and it has significantly impacted the financial markets. We want to take this opportunity to update you on this rapidly developing situation and discuss how major geopolitical event has and will further impact financial markets. Before we start, allow me to provide a brief introduction of MYTHEO. Being an award-winning digital investment manager approved by the Securities Commission, we leverage on technology to offer you personalized, convenient, and affordable way to build your wealth. Our proven proprietary algorithm help identify the best investment while keeping risk at bay. Similar to how Theo financially supported his brother Vincent van Gogh to achieve his dream. MYTHEO aim to help you achieve your financial goals and enable your moments in life. A quick rundown of our 1 hour session today. It will be in Q&A format with live polls in between. Meanwhile, if you would like to ask the speaker any question, you can interact with us via the Q&A button on top of your screen. I'm joined here by Matthew Stuart-Box, our Chief Investment Officer of MYTHEO, where he's responsible for the development of all investment algorithm, portfolio management, and trading at MYTHEO. Besides that, he's also the Chief Operating Officer of Theo Japan, where he's responsible for all investment platform-related teams, including portfolio management, trading, and operation. Before we start, if I may ask you a question. Which of these concerns you the most today? Please choose the one that is the most concerning you today. Okay, thank you for your participation. Let me just share the result. It seems like the main concern that we're seeing today is the rising inflation, the sustained low growth environment, and also geopolitical tension. So these are the top one is the rising inflation interest rate. So we'll be addressing that as well today. All right. First question to Matthew. Can you help us to outline the background of this conflict and what we've seen happening so far?
Yeah, sure. Thank you, Simon. Yeah, maybe I can lay a little bit of the background to this before we move into kind of the specifics of markets and things like this.
Sure.
So as you mentioned, yeah, so Russia invaded Ukraine on the 24th of February. This has been coming for a while, obviously. You know, they've been building up troops towards the end of last year and all through January, but they actually invaded on the 24th. Right now, there are somewhere between 100,000 and 200,000 Russian troops in Ukraine. And as at the moment, they occupy around 15, maybe 20% of the land of Ukraine. Obviously, the war is still ongoing, and there's been casualties over the last 2 weeks or so. The number of people is still unclear, but certainly several hundred Ukrainian civilians have been killed. And on the military side, the numbers are still very unclear, but at least several hundred and quite possibly several thousand Russian and Ukrainian soldiers have been killed in the conflict. There's also a huge humanitarian problem in Ukraine now, with about 2 million people, refugees from the conflict, trying to flee to other parts of the country or to neighboring countries.
Sure. Our thoughts are with the people of Ukraine, and we hope that the war can end as soon as possible. So back to the topic on investing. How has Russia-Ukraine war affected the asset classes and the market so far?
Sure. Maybe I can just find the right file to show here. Maybe if we start with an overview of what's been going on in the markets, that might be the place to start.
Sure.
So these graphs show the market performance of various assets since the start of the year. And so on the top left there, we have various stock markets, how they've performed. The top right is the Russian stock market. And then on the bottom, we have various commodities markets and some other indicators of risks. So I'll maybe explain a little bit about what we can see from these. If we look at the top left, so the major stock markets, the blue line here is the S&P. So this is the US. And since the start of the year, the S&P is down about 12 or 13.
Sorry, Matt, can you enlarge the slide?
Oh, thank you.
Slideshow.
Yeah, sure.
Thanks for the feedback from one of our audience.
Thanks. Oh, sorry. Yeah, that's better, isn't it? Thank you. So the S&P is down about 12% in dollar terms, and overall global average markets are down about the same. You can see that orange line down here. This is MSCI Europe, and you can see there that's fallen further naturally than the US, given the proximity to the war. But you can also see it's been really quite volatile. We saw it jump up, for example, on Wednesday this week, and since then start to fall back again. But if we look at some of the other markets up here, this gray line here is the MSCI Emerging Markets Index. And you can see it started to fall a little bit over the last week or so, but it's been much more resilient than Europe or the US. The green line here is MSCI Malaysia. And you can see there, it's basically flat since the start of the year. So you can see, the impact has been different for different markets. If we go to the Russian market, obviously the Russian market has been closed since the end of February. So we don't actually know what the true price is of the Russian stock market, but we can get an indication from this, which is the Russian equity ETF, which is traded in New York. This ETF also, the trading has been halted since the last week or so. And so you can see it's been flat for the last week or so. But at that point, it was down about 80% since the start of the year. So it's had a huge impact on the value of Russian stock market. If we look at commodities, obviously the picture is quite different here. Obviously, the commodity that's got the most attention has been oil, and that's that gray line here. And you can see the oil price was rising before the invasion, but obviously the invasion pushed it up again. It's moved quite a lot over the last week or so, and it's now up just under 30% year to date. So it's risen, but it hasn't gone crazy yet. But you can see some other commodities also have been affected. This blue line here is the wheat futures. Obviously, Ukraine is a very, very large producer, a very large exporter of wheat. And you can see this shot up very sharply on the back of the invasion. It's since come down a bit, but it's still up over 40% year to date.
Sure.
The orange line here is gold. It's been gradually going up. Obviously, this is a good indication of geopolitical risk, but it's still only up about 10% year to date. Some of the other risk indicators over here, this gray line is the VIX, which is a measure of the volatility, the expected volatility of stock markets. And so you can see people are expecting much more volatility than they were at the start of the year, and that makes sense. And this orange line maybe here is US Treasuries. Often these are seen as a safe haven in geopolitical risk times, but this time around, actually the price of US Treasuries has been falling. It's down about 9% year to date. And obviously that's linked to the inflation concerns that I think many of the people on this call are also interested in.
Sure. So while commodity as an asset classes has benefited from this, we have seen huge correction from equity market. So while there can't be any exact historical parallel to what has transpired in the market, right? Would you be able to share with us how market has reacted to something similar in the past?
Yeah, sure. So I think it's a very good point. You know, all of these kind of conflicts, these geopolitical events are unique, but maybe there is something we can learn from looking at how the market has reacted to other events in the past. So this table here shows various macroeconomic geopolitical events in the past, going back over the last 60 years or so. And so it includes things like Pearl Harbor attack, Kennedy assassination, various terrorist attacks as well. And it shows here the total drawdown of the S&P as a result of that event. And then how many days it took for the S&P to recover. This column right at the very right-hand side is the number of days from for the index to recover to its pre-event level. And out of these various different events, perhaps the one that's closest to the events in Ukraine is this one that I've highlighted here, Iraq's invasion of Kuwait back in 1990. And obviously the reason why I highlighted this one is, you know, this is an invasion of one country by another. And obviously this also involved oil to a large extent. So there are some parallels with the situation in Ukraine. Obviously they're not exactly the same kind of events. In the case of Kuwait, the US and other countries were participants in the war. They were active participants in the war. Obviously, in the case of Ukraine, there's no sign of NATO getting directly involved. So it's not a perfect parallel, but it might give us some clues. And we can see here, in the case of the Kuwait invasion, the S&P fell 16.9%. So I mentioned earlier, the S&P is down about 12% year to date. So it's in the same kind of ballpark as the reaction to Kuwait. And then if we look at how long it took to recover, here we see 189 days. So this is basically 6 months for the S&P to get back to its pre-event level. I'm not saying that, you know, that's how it's going to play out in Ukraine, but that's the kind of horizon we could do. The other thing to note is, obviously, the number of days here varies a lot. In some cases, the market reacted and recovered very quickly, and in some cases it took, you know, up to 6 months. So it's very unclear as to how soon or how long it will take, but this might give you an indication of what could happen. The other thing related to the Kuwait war that's worth noting is what happened to the oil price as a result of the Kuwait invasion, and that's on this chart. So this shows a long history, 70-year history of crude oil prices. And you can see on a long-term horizon, they're very volatile. They've gone, you know, from $20 way up to nearly $200. This spike here is the Kuwait invasion. And so you can see the oil price going from under $40 to over $80. So the oil price more than doubled at the time of the Kuwait invasion. But what you can also see is that the oil price fell back to its normal levels very quickly afterwards. That was partly a function of the war ending relatively quickly. But as you can see, you know, in this case, while the spike in oil prices was quite extreme, it was not long lasting. Changes in structural supply of oil, such as the oil shocks back here in the 70s, or changes in the demand for oil, such as in the early 2000s and in the recovery from the pandemic, these tend to be much more long-lasting impacts on the oil price.
Sure. So I mean, well, it took 6 months, right, for S&P to recover. So, with the continued geopolitical tension or potential escalation between Russia and Ukraine, what should investors watch out for in the coming days or weeks?
Yeah, sure. I think we saw this concern from the poll that you did at the start of this session, where people are concerned with inflation and they're concerned with slow economic growth.
Yep.
And this is a word that's been mentioned several times. This word of stagflation, and I think that's what we have to watch out for. So stagflation is this combination of low or negative economic growth combined with high inflation.
Yep.
The point is, stagflation is a very rare occurrence, and right now, most economists are not predicting this to happen to any of the major economies this year, but it is possible. So, what should you look out for as a potential indicator? Well, I think there's maybe three things that are worth looking at. One is US interest rates. And in particular, the difference between long-term interest rates and short-term interest rates. And this is what people refer to as this yield curve inversion. If you see that, normally you would see that long-term interest rates tend to be higher than short-term interest rates. There's more risk in lending money for a long period of time than for a short period of time. But if you expect a sharp increase in inflation, then short-term interest rates should rise. And if you expect a deep recession, then long-term interest rates should fall.
Yep.
And so you could see the situation where short-term interest rates become higher than long-term interest rates. And that's what we mean by the yield curve being inverted. This graph up here shows the gap between 1-year and 10-year US interest rates. And so you can see normally the gap is positive. 10-year rates are higher than 1-year rates. But every now and then it dips down to zero, and in some places even negative. And this would be a warning sign for a very sharp recession and potential stagflation. Right now, we're not there. The US interest rate curve is still sloping upward, but this certainly would be one indicator to watch for.
Yeah.
The second one here is a US jobs market. We'll come back to this when we talk about the Fed a little bit later, perhaps. But the US jobs market is extremely strong right now. It suffered a large shock as a result of the pandemic, but it's recovered very, very strongly. Jobs growth in the US is very strong. And I think if we see any sign of that jobs growth slowing, turning negative, that would also be a red flag in terms of stagflation.
Sure.
And the third thing is you've got to look a little bit broader than just the US. You've got to think about the Chinese economy as well. And probably the best indicator there is PMI, so this Purchasing Managers Index, which is an index of kind of the how optimistic manufacturing managers are in China. And if this turns below 50, so a net negative outlook there, then this would be a sign that the problems in the Ukraine, the problems in Europe are spreading, not just to the US, but also to China. And if that was the case, then you might start to get worried about a global slowdown in economic growth. As I said, none of these indicators are at that point yet. But if you want to watch out for potential signs of stagflation, I would say these three are the things to look at.
Sure. So I think the main concern here that we are looking at is obviously we have just sort of like recovered from COVID, and the potential for inflation to spike is real with this war that is happening. So I mean, with all these factors in place, right? Will it cause a long-lasting economic damage?
Yeah, sure. This is a very good question. And, given all of the news coverage, it's very easy to assume that this is going to be a very large economic impact. But if you unpack it a little further, it's not quite as simple as that. So first off, let's just start and look at just how big the Russian and the Ukrainian economies are. This is a graph showing the total GDP of the world split by country. And if you add up all of the GDP of every country in the world, you get an answer of about $100 trillion per year. And naturally, the biggest single country is the US, accounting for maybe a quarter of that, and then China, and so on and so on. You can see here, Russia accounts for 1.7% of total global GDP. So it's relatively small. It's about the same size as Brazil or South Korea. Ukraine is even smaller. You can see right up at the top there, it accounts for 0.2% of the global economy. So neither of these economies on their own are particularly big from a global point of view. Similarly, if you look at it from a kind of a stock market point of view, you add up the value of all of the stock markets in the world. Naturally, it's dominated by the US and China. The Russian stock market, even before this recent fall, even before that, the Russian stock market was still small, so it only accounts for 0.7% of the global stock market, and the Ukrainian stock market is tiny.
Yep.
So the impact from there is likely to be small. But of course, everybody's concerned about the impact on the energy market, oil and gas. And here the picture does look different, obviously. On the left-hand side here, we have global oil production split by country, and on the right-hand side, natural gas production. And obviously, Russia is an important player in both of these markets. 13% of global oil production, so it's bigger than Saudi Arabia. So it's an important player in the global oil market, and 17.5% of total natural gas production. So in that sense, it's an important part of the global energy economy. But if we try and quantify how big an impact this is likely to have on GDP growth and inflation, you get something like this. So this is from a research institute in the UK, the National Institute of Economic and Social Research. And they did a study looking at the potential impact of the conflict on the global economy. And so the way to look at this is 0 is the base case. So if there was no conflict in Ukraine, then that's the base case of 0. And relative to that, how big an impact is the conflict in Ukraine? And so this is saying that in 2022, so this year, they expect global GDP growth to be roughly 50 basis points, 0.5% less than it would have been without the conflict. And then 1% lower in 2023. So just to be clear, they're not predicting that the global economy will shrink by 0.5%. They're simply saying that growth will be 0.5% less than it would have been. So perhaps instead of 4.5% global economic growth this year, we get 4% this year. So the impact based on these kind of simulations is material, but it's not outrageously big. And if we think about why that might be, we can look at like how much the global economy depends on oil. And so the graphs that we have here on the left-hand side show global oil demand through time. And you can see it's gradually going up as the global economy expands. But the graph on the right is the important one. This shows the amount of oil that's used to produce $1 of GDP. So this is a measure of oil intensity, how much the global economy needs oil in order to grow. And what this is showing is this is gradually falling. And that makes sense. Globally, people are moving away from fossil fuels, solar energy, wind energy, that kind of thing. So moving to renewable fuels. But then also energy efficiency is rising. In cars, industry, anything, global energy efficiency is rising. And so the reliance on oil compared to, say, the time of, for example, of the Kuwait invasion 30 years ago is perhaps half as much as it was. And so while an increase in oil prices is still negative for economic growth, it's not as bad, it's not as impactful as it was, say, 30 years ago. So that's from a GDP point of view. Obviously, the other concern is an inflation point of view. And so this is from the same analysis But they're looking at it from the point of view of inflation. How much has this conflict added to global inflation? And we can see here, they're estimating that global inflation this year is going to be about 3% higher than it would have been without the conflict. And then the impact fades a little bit in 2023, so 2% higher. So obviously these are estimates. There's no guarantee that these are correct, but this gives you an indication of the potential impact on global GDP growth and inflation from the conflict.
Yeah. So you mentioned that there will be negative impact to the GDP. While we know interest rate or inflation rate in US is actually very high now at 7.9%, the latest numbers, right? So how would this complicate the decision for Fed to raise interest rate?
Certainly, yes, yeah. You're quite right. It does make it a little more complicated for the Fed. The Fed is concerned about inflation, both from the point of view of demand pull inflation. We've seen that the job market is very strong in the US, but also from the point of view of cost push inflation in terms of rising input prices, in particular oil. These are from the minutes of Fed meeting. This on the left-hand side shows the expected interest rate rises that the Fed themselves are predicting over the next few years. So you can see they're predicting a gradual increase in the interest rate, maybe 25 basis points this year, another 25 basis points next year, up to about 2.5% 3 years from now. This is what they're predicting. And then on the right-hand side here, the chairman of the Fed, Jerome Powell, gave testimony to the Congress back at the start of this month. And this quote from him is worth noting. We expect it will be appropriate to raise our target range for federal funds rate, to raise the interest rate at our meeting later this month. So the Fed has made it very clear that they do intend to go ahead with the interest rate rises that they planned. So they're taking this very seriously, but they don't expect to be derailed at the moment as a result of what's gone on in Ukraine.
So with this interest rate potentially going up and a war that could impact economic growth, so how would this translate to companies' earnings?
Sure. Well, that's the big question, and it's too early to say right now. Various companies have announced reductions in their operations in Russia, but very few companies have actually updated their earnings forecasts as yet, as a result of what's been going on in the Ukraine. I think it's important to remember that stock prices are really driven by two things. One is earnings. So the earnings of the company, their current earnings and their future growth. And then those future earnings are discounted back to a present value based on some kind of discount rate. And that discount rate depends on risk appetite. And really the stock price is driven by these two elements. So if you look at it from an earnings point of view, it's still too early to say, but it's clear that the impact will vary by sector and company. Banks, consumer businesses that have big operations in Russia will obviously suffer, but the exposure to Russia varies a lot by company. Obviously, you can expect that energy-intensive industries are going to suffer, things like airlines, transport, heavy industry, anything that relies on serious amounts of energy will face higher inputs. But on the flip side, energy companies, for example, in the US, exploration companies, infrastructure companies will benefit from the rise in oil prices. So it's not that all companies have a negative impact. These impacts could last several years, but as we've seen, given the relatively small size of Russia to their global economy, it's unlikely they're going to be permanent damage to company earnings. Where we will see volatility is with risk appetite, and we've seen this even over the last few days. Even small amounts of news from Ukraine in terms of potential ceasefire talks, things like that,
Mhm.
are enough to trigger 2-3% moves in the stock market. And that's due to people reassessing their risk appetite. And I would expect that kind of volatility to continue.
Sure. I have this question here. I remember in our last webinar, you mentioned that global supply disruption to the oil is yet to be recovered, right? Yet to be resolved. So with US just announced that they are imposing sanction on Russian oil, right? What will be the impact? And will Europe follow suit?
Sure. This is a very, very pertinent question. I mean, the point with the US is the US doesn't need Russian oil at all. The US is essentially self-sufficient in energy. This graph here shows a long-term history of the blue line here is consumption, and the brown line here is production. So you can see for a long period during the 80s and 90s, the US was a very heavy importer of oil. But obviously, with production has ramped up with new technology in fracking and things like that. And now essentially the US is energy sufficient. And so they can afford to stop importing Russian oil without any particular impact. Obviously, the picture is very different in Europe. These show the energy imports of Europe by country. And so on the left-hand side here, we've got the imports of oil. 26.9% of Europe's oil comes from Russia. Obviously, the big one here on the right-hand side is natural gas. 40% of Europe's natural gas comes from Russia. But it's not just oil and gas. Things like coal. This hasn't had that much publicity, but nearly half of the coal that's used in Europe is from Russia. And so you can see, obviously, Europe is heavily energy dependent on Russia. And these things can't be changed overnight. It's not something where you can swap it out very easily. Obviously, countries like Germany in particular, but other countries in Europe have indicated they'll be moving away from Russia, cancelling oil pipelines and things like that. But this does limit, in the short term at least, the degree to which Europe can turn off Russian oil and gas. Sure.
So, well, obviously, supply disruption is something that is concerning us. Besides crude oil and natural gas, right? Can you share with us what's Russia's exporting and where are those exports going to?
Sure, yeah. This is a very useful summary of where Russian exports go. And so it looks at all of the exports from Russia in 2019 and groups them by the kind of product. And so you can see here this huge kind of brown part here. This is all energy-related stuff. So crude oil, refined oil, gas, coal. This accounts for roughly 50% of Russian exports. And then down here are the other commodities, gold, platinum, things like that. So it's a very much a kind of raw materials, raw energy based export market. And so losing these or serious reductions in the ability to export these kind of things would be extremely serious for Russia. If you look at where those exports go in terms of the countries that they're exporting to, it looks like this. So this is taking the same data, but splitting it by the destination, the country to which Russia is exporting. And a couple of things stand out. Up here, the US is relatively small. We've said that the US doesn't rely on Russian oil, but only 5% of Russian exports go to the US. So it's not a big trading partner for Russia. The big ones are Europe in general. So over half of Russian exports go to Europe. In particular, Germany is a very big partner. And then obviously China as well. Energy exports to China, raw material exports to China are also a very big part of the Russian economy.
Yes, before we go to the next question, if I may ask a question to our audience, what do you currently invest in? If you can select all that applies. Okay, thanks for your participation. So, yeah, so equity seems to be the highest asset class that our investors are investing in, and followed by fixed income, commodity, cryptocurrency, commodities. So, yeah, so that's the good understanding of what kind of exposure that we're having here by our audience. So Matt, rising inflation and obviously near certainty that we're going to see high interest rate from now, and the expectation that corporate profit will pull back, right, all point to probably dramatically lower stock and bond return than what our investor has accustomed to. So what should the investor do now? And could this be a good buying opportunity?
Sure. I mean, this is the big question, and it's true, as you say. You know, the situation is negative for company earnings, probably negative for bonds, positive for many commodities. If we look at kind of, you know, what kind of advice other people have been giving at the moment, most people's advice right now. This is an example from Fidelity. Most of the advice right now is not to make dramatic changes to your portfolio. As we've seen, you know, we've discussed, you know, the overall economic impact, certainly in terms of real GDP growth, is not that large. And so most people are not recommending that you make huge changes to your portfolios. Stay calm and focus on a long-term horizon. It's very easy to think that, you know, this situation in Ukraine is a terrible disaster, and it is a humanitarian disaster. But from a long-term economic point of view, in most cases, conflicts like this, wars, do not have big economic consequences in the longer term. So the kind of advice I would give to investors out here at the moment is, number one, don't panic. It's very easy to be taken in by all of the headlines, wall-to-wall TV coverage, and think that you have to make some kind of dramatic changes to your portfolio as a result of it. I don't think that is the case. The most dangerous thing you can do right now is to try to time the market, to try and guess when you think the market will fall further, and in particular, guess when you think the market is likely to recover. It's very tempting to think I should take my money out right now, wait, and then put my money back in at the bottom. The problem with that is it's extremely difficult to predict when the market will recover. We've seen in the earlier slide there, when we looked at how many days it took for the S&P to recover to various geopolitical events, there's a huge range. In some cases, it's very fast. In some cases, it can be multiple months. We've also seen over the last week or so, large swings in the equity markets, both on the upside and the downside. Very big reactions to relatively small amounts of information. I think we can say confidently that the stock market will recover from this, but it's extremely difficult to say when. The other thing I would say is, don't delay starting to invest. Don't think you should wait until things calm down before you start investing. This is also a very common mistake that individual investors make. The point is, if you wait until things have completely calmed down, the markets will have fully recovered and you will have missed any kind of upside. So I would recommend that you don't wait and see. So what should you do? Well, you should take a long-term approach. As I said, this conflict will will be resolved at some point, and the long-term economic effects of it will be small. So don't be diverted by this kind of thing. You should keep your portfolio diversified, and that means many things. Diversified across different markets. We've seen that different equity markets have reacted very differently to the events in Ukraine. Some have fallen a lot, some have hardly fallen at all. Diversify across asset classes. We've seen that both equities and bonds overall have been negative, but many commodity assets have been extremely positive over the last month or so. And then also diversify across time. And this is this point about not trying to time the market. One of the most efficient ways of lowering your risk is to invest a regular amount of money, say, for example, every month. This takes advantage of the fact that, when market has fallen, you'll be able to buy relatively more assets with that fixed amount of money. This is a very common term known as dollar cost averaging. But what it means is that you are able to smooth out your purchases, smooth out a lot of the risk. So this element of diversification in multiple dimensions is the best way to approach this kind of uncertainty. The point is, this is what MYTHEO was designed for. MYTHEO can help you with this. It's naturally very well diversified. And these portfolios are tailored to the needs of the individual investor. So I would recommend this kind of approach in an environment such as this.
Sure. So, well, in the context of the current situation, right, how should the allocation be for investor who is probably looking to add on to their investment?
Yeah, sure. So it's a very difficult choice as to how much of your assets you should put in each asset class, how much to put in equities, how much to put in bonds, how much to put in real assets. And MYTHEO can help you with this. This is part of what our product was designed to do. We have 3 different portfolios. This growth, income, and inflation hedge portfolio, each focused on different asset classes. And so the growth portfolio focused on equities, income on bonds, and inflation hedge on real assets. And MYTHEO can give you a recommended allocation across these 3 asset classes based on your situation. So based on your age, your income, your investment horizon, your investment goals, MYTHEO will give you a recommendation across these asset classes. And that's probably the place to start. If you have a strong view, on top of that, you can choose to customize that allocation as well. But MYTHEO can give you a target allocation that we think is the best allocation for you in the longer term. Now, these portfolios are highly diversified. So they invest in 59 different ETFs across a range of different asset classes, equities, fixed income, real assets. And then the underlying assets that these ETFs invest into are extremely broad. Over 10,000 individual companies, individual bonds are included in the MYTHEO portfolios. And the point there is that means that you're very unlikely to be damaged by any individual company or any individual asset class.
Yep.
This is all related to the correlation between asset classes. The whole point of having investment into different asset classes is that they don't all move together. Yep. This table here just shows how varied some of this correlation can be. So a score of 1 would mean that the asset classes move exactly together. And anything less than 1 means that they have some degree of differentiation, some benefit from diversification. And you can see here, for example, from the point of view of US equities, investing into bonds has very low correlation with these. Commodities has very low correlation with US equities. And so even a relatively small allocation to the bond market or the commodities market can lower your overall risk, lower your equities risk an awful lot.
Yep.
You don't need a big allocation to other assets. This shows here just how quickly your risk can fall as you invest into other instruments with different levels of correlation. But even if you look at something with a correlation of 1/3, adding 5 or 6 other assets can reduce your risk from 10% to something close to 6 or 7%. So it has a very good impact on your risk profile.
Yep.
And then the other point is, we've been managing this for a long time, and we've got a lot of experience in managing this, and the MYTHEO portfolios do work. What we've got here is the performance on the left-hand side of the MYTHEO portfolios during the actual invasion. So this is the performance during February. And you can see the growth portfolio with its exposure to equities suffered. It was down 2.7%, but compared to the US equity market down 12% year to date, Europe down 13%, 14%. The diversified growth portfolio did quite well. Income was also negative, but only by about 0.7%. But the inflation hedge side, so this is the portfolio invested into real assets. This has exposure into gold, exposure into oil, commodities such as wheat. So you can see this portfolio was up during the month. And MYTHEO clients hold a blend of these different portfolios. Obviously, the weight for each client depends on their situation. But they have a nice diversified mix across the asset classes. The right-hand side over here shows some long-term history of a kind of a representative portfolio of MYTHEO. Way before the Lehman shock, all the way through to February this year. And you can see in the long run is provided a cumulative return of over 140%. So this is like an annual return of roughly 6 to 7% for a well-diversified, relatively low-risk portfolio. And so even though the events and the news right now can look quite scary, when you take a 10-year view, 15-year view, a diversified portfolio can be a very good way of growing your assets over the long run.
Sure. Thanks for that. So let's go through the question from our audience. So first question, with the present geopolitical situation, what has MYTHEO done, if any, to accommodate this market volatility? How often are adjustments made to the algorithm?
Sure. This is a very, very good question. So the answer is we have not made big changes to our portfolio as a result of the situation in Ukraine. As I mentioned earlier, we don't believe that this has a large long-term economic effect, a large long-term fundamental effect. It has impact on the risk appetite, but these are temporary and quite volatile. So we have not made big changes to our portfolio. We do have an AI-based risk assessment that runs on all of our portfolios, which aims to pick up markets that have extremely high risk. Right now, our exposure to markets such as Russia and Ukraine is tiny. We have almost zero exposure to those markets themselves. And so as a result, the AI risk assist has not made big changes to our portfolio.
I see. Okay. So and the second question, I remember we highlighted this in our previous webinar. When was the last stagflation and how long is the period? I remember you mentioned it's in the 1970s, right?
Yes,
and it's lasted until 1982, right?
Yes, yeah, that's about right. Yes, so so as we said, yes, stagflation is very rare. It's not something that happens frequently, and the main case that people look at is the 1970s in the US, where the oil price, as a result of the oil shock, rose roughly 200% from the mid-70s in 2 jumps. That triggered a very steep recession in the US, and they didn't really get out of that recession until the early 1980s, and that required steep interest rates, a large spike in unemployment in the US in order to kind of flush that inflation pressure out of the system. And so if we were to get into stagflation in a country like the US or some other country, it would take multiple years to get out of it. But just to be clear, nobody is predicting any major economy to fall into stagflation this year. Nobody is predicting that. So it is a possibility that's out there, and it's worth monitoring it, but that is certainly not the base case scenario.
Sure. Okay, so the third question, I think that's related to the first question that you addressed on the Russia stock market, which has dropped 80%, right, since the outbreak of the war. So how to invest in Russia stocks that are listed in the UK?
Oh, right. That's nice and aggressive. Well, okay. So I would say the simplest way right now to invest, if you do want to invest into Russian stocks, is to invest into a Russia stock ETF that's listed either in the US or listed in Europe. And there are several providers who offer those kind of ETFs. And so you can trade those just the same as trading a US equity or a UK listed equity. As I said, right now, because the Russian stock market is closed, right now, those Russian ETFs are also not trading as of right now. Okay, and so you cannot go out right now and buy units in that Russian ETF. I agree, it might be a little bit tempting if you think an 80% fall is kind of tempting, but as of today, you cannot buy those ETFs. I think you've got to wait until the Russian stock market reopens before you can buy into them.
All right. Okay. All right. Okay. So let's move to the next question. So this question is about dollar index. Will dollar index hit 100 in 2022 after the second rate hike? And second question is, what happened to the market if the war is ending with a stalemate?
Yeah, maybe let's start with the second question. Yes, if the war ends with a stalemate, and that certainly is a potential outcome. Yes. A stalemate between Russia and Ukraine, perhaps with Russia occupying part of the Ukraine and the Ukrainian government staying in control of the rest of the country. That's certainly possible, and that may well be the most likely outcome. And to be honest, if that is the outcome, one would expect a sharp rally in the stock market. Because what people are worried about right now is the war spreading to other parts of Europe, in particular to other ex-Soviet countries in Europe, places like Baltic states, even potentially Poland, somewhere like that. A stalemate in Ukraine would mean that the risk of that happening is lower. Probably the sanctions against Russia would remain, at least in some form, but as we've seen, the Russian economy is small, so that doesn't really matter so much. So a stalemate, in my opinion, and so I'm not an expert on kind of geopolitics, but in my opinion, a stalemate would be positive for certainly global equity markets, in that it takes away some of the uncertainty and the risk of contagion onto other markets. The first question was about, I believe, about the oil price. Could you just...
No, it's dollar index. Actually, dollar index, question is, will dollar index hit 100? Now it's at 99 already. Yeah, it's been gradually rising.
Sorry. Yeah. So kind of the dollar exchange rate. Yeah. So the exchange rate is driven by a lot of different things. right now, obviously, it's driven by this mix of higher interest rates, which are positive for the dollar, but higher inflation also in the US, which is negative for the dollar. And right now, that balance is unclear as to which will come out stronger. If there's signs that the inflation in the US is temporary and not going to be particularly persistent, we've seen a spike in inflation, and the big question is, does it stay high or does it start to fall back down again? If we start to see the inflation start to fall back down again, and the Fed moving to this kind of longer run target of 2.5% interest rates, then I would expect that to be positive for the US dollar. And it could well, the dollar index could well go over 100 years.
Sure. Okay, so there's one more question. There's another question here. Will ESG compliance able to override sanction impact?
ESG compliance. Right. So ESG compliance. So I would expect. I'm not sure I quite understand the question, but I would expect that, at least in the short run, the impact of sanctions is much bigger than the impact of ESG. Sanctions are specifically saying you cannot trade with this country, you cannot trade with this company. And so that's obviously, depending on the company, that has much bigger impact than ESG. Having said that, in the long run, events like this in Russia do put more attention on ESG in the longer run. And so in the short term, you'd expect sanctions to have the greater impact. But as a result of what's been going on in Russia, people are reassessing their activities in Russia, reassessing their dependency on Russian energy. And so in that sense, you could imagine in the longer run, the events in the Ukraine leading to more focus on ESG factors going forward.
Sure. So I think we have one last question here. Started investing with MYTHEO a couple of weeks ago. Noticed that it is quick to respond, and fund invested is reflected a day after crediting. How soon can this fund be invested on the day of investment?
Yes. Okay, so thank you for joining, MYTHEO. You're correct. Yes. Normally, what happens is we trade the investments in MYTHEO during the night in Malaysia. Most of the actual ETFs that are held by MYTHEO are traded in New York. And so if you make a contribution into your fund today, then we will trade it tonight in New York. So you'd normally see it reflected in your portfolio the next day.
Sure. Okay, so I think we have addressed all the questions here. Thank you, Matthew, for the great insight on the complex and quickly evolving situation on the Russian-Ukraine war. So the key takeaways that I have gotten here are, let me share my screen. Okay, so first is, although every geopolitical event is different and unique in certain aspects, they all typically have something in common: a combination of falling market, a higher level of volatility, and investors' uncertainty. And the second one is, I suppose we have experienced a number of these situations in the past, with the most recent being COVID-19 sell-off in March 2020. However, our job is not to predict what will happen and when will happen, but to construct a portfolio in such a way that helps to reduce the impact of this event by incorporating risk management strategy like diversification to low correlation assets, such as real assets and commodities, to keep the portfolio resilient and deliver good return over medium to long term. Okay, so the third one is that while we don't exactly know the current event, how would it play out, we are confident and has high conviction on our diversified approach in growth, income and inflation hedge portfolio that makes up our recommended portfolio allocation to deliver for investors for over medium to long term. So before I end, if I can just ask the last question, in what direction do you expect your investment allocation to move in the coming 3 months? Would you be looking to increase your investment, lower your investment, or maintain your investment? Let me just share the results. So we have close to 60% of our audience here are looking to take advantage of the war to increase allocation, and most of it, and the rest are maintaining their allocation, and 4% are reducing their allocation. Thanks for the participation, and I would like to thank you very much for your time today, and I hope to see you guys again in the next webinar. Thank you.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision-making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.